Good morning, all. Hopefully my technical difficulties will be cleared up and my mic will be working in a moment, but while my panelists are getting settled in, for those of you that are looking at your booklets, I am not Brad Behrman. I'm Brian Devine. I'm the head of transport for the United States at Norton Rose Fulbright. And I like to think that I'm the younger and better version of Brad, and since he's not here today, there's no one here to argue that point. Before introducing, well, I'm going to let my panel introduce themselves, actually, and give a little bit of their own personal background and views to get started off. But before doing that, I like to do things in reverse order a little bit. I'd like to pose what I hope to be the final question for this panel so they can consider it while we're discussing the various other items. And that question is, are the capital markets, and in particular New York, have they been a valuable tool in the toolbox of the shipping industry? Or is this all just way too sexy for shipping? Should we be returning to the traditional ship model that some of the bankers were just talking about? Because it works, and it had worked for quite some time. Have the capital markets exacerbated this current cycle? So I'll leave that to the end, and hopefully we can return and discuss that. But in the meantime, I guess perhaps going from Andrew across, if you guys can each maybe spend about a minute introducing yourselves and discussing your backgrounds, that'd be greatly appreciated.
Well, thank you, Brian. Good morning, everybody. I'm Andrew Horrocks. I'm co-head of our transportation group at Credit Suisse, which includes shipping. I do a lot of the shipping work for our firm, and we also have a substantial ship lending business as well as all the investment banking platform that you'd expect.
Hi, good morning. I'm Kwon. I'm a managing director at D&B Markets, focused primarily on the shipping sector, and very pleased to be here.
Yeah, Marius Halvorsen. I'm the CEO of Fearnley Securities here in New York. Before I started Fearnley here in New York, I had the same position at Plato, which we sold to Clarkson 2 years ago. Before that, I worked with Paul Leon over at AMA Capital Partners, and then I was 6 years at Goldman Sachs in London. Thank you.
Hi, I'm Adam Vore. I'm a managing director with Stifel Finance. Before that, I was with Bank of America Merrill Lynch. And before that, I was at Citigroup. Thank you.
Great. Well, thanks, guys. And just another housekeeping item. I welcome open discussion and questions from the floor, in particular open discussion amongst the panelists. I always find that very helpful. Now, in shipping, we tend to be very provincial, and we think we're the center of the world or the most important people around. Before we get to the capital markets in relation to shipping, I was wondering perhaps we can discuss a little bit the general capital markets, because I'm not so sure, shipping is all that horrible, perhaps in comparison with respect to new issuances and the like over the past, say, 12 months. So maybe from Adam back down, if I can get your views on that, it'd be greatly appreciated.
I'm sorry, could you repeat the question?
Yeah, the broader capital markets in general and new issuances over the past, say, 12 months in relation to shipping. Is shipping really that different than the rest of the market?
I think it's clear that shipping has lagged the rest of the industries within the capital markets. I think that in today's market, you're starting to see institutional investors come back in, and they're being very targeted in who they're approaching. They're definitely looking for companies with contracted cash flow and that have good quality relationships with the market and reputations with the market.
Any other views on shipping in comparison to the rest of the market?
Yeah, I mean, I guess, we have colleagues at D&B who cover the energy space, and, I just spoke to them yesterday, and they said that, frankly, we saw shipping get impacted by energy very significantly. It was obviously a very strong correlation there. But we're actually seeing quite a bit of strength in the energy markets now, as people think that oil may have stabilized between this range, and we're seeing that in terms of obviously issuances on on the high yield and the investment grade side on the energy, in the energy sector, but we haven't, I think, quite seen the same level of activity in shipping. And so I think to Adam's point, there has been, I think, this lag in shipping versus, I think, if I were to compare it to the energy side.
I'll take a crack at it. I think the market, overall stock market this year has been characterized by a high degree of volatility. We saw that in January where there was a very significant sell-off. Much of it was energy oriented, but there were broad macro concerns at that time that still are in the psyche of the institutional investor. Energy is one of them, as Jay points out. China is another. The implications of Brexit and rising interest rates and so on and so forth, all of which directly impact the commodities, by the way, massive fall in commodity prices, all of which directly touch up against shipping. And so, these macro issues, which put us really, the institutional investors, very defensive. It's just not a good environment for, risk trades, that tend to be cyclical bets. And so the overall backdrop has been, not great, despite the fact that the overall level of the S&P 500 may be up. It hasn't been good for issuers. It's a defensive market that favors, as Adam said, contracted cash, food companies, public utilities, and so forth. And I think as there hasn't been an IPO in nearly 2 years in the shipping industry, the IPO market, which is a window into the institutional investor taking new risks, has been very quiet, very soft overall. And so I think, the shipping industry is going to, like other deep cyclicals, going to get the worst of it in a market like this.
Yeah. Well, that kind of touches on, we have seen some secondaries in the somewhat recent past. What are your views generally on that market? In pretty much more the nearer term, I would think. Marius, any thoughts?
No, I think, first of all, I think that the shipping industry lends itself very well to the capital markets. It has an embedded volatility that you can hardly find anywhere else. It's relatively easy to understand. It trades in reasonably large blocks at a time. And I think, therefore, it will be always very suitable, particularly here in the U.S. market. We had a bank panel here on a few minutes ago. Of course, most banks have been long and wrong for almost 10 years, and they're struggling with legacies from the past, which is also why people say, there are no financing, bankers are not there to underwrite loans. Of course, at the same time, we see a large inflow of alternative capital. We see companies like Breakwater, Entrust, Norton Navigation. These type of companies are filling the holes. And I think, because the shipping industry per se is relatively simple, I think there will always be room for equity markets, which we have seen quite recently in a number of companies. We've seen Scorpio Bulkers doing 2 transactions this year in the worst of markets. We have seen Eagle Bulk coming out of a restructuring. We have seen TK restructuring basically their entire corporate structure. We have seen Odfjell recently doing a bond offering, and Ocean Yield the same to refinance their previous existing debt at only 50 basis points over what they had. So I think this business lends itself tremendously to capital markets, and I think that the sort of depressed headlines we get is typically from these institutions that are constantly sitting long and wrong, whether they are private equity firms that came in 2013, or whether they are banks that have kicked the can down the road all the way till here.
Thank you. Very comprehensive. And along the similar lines, I've been hearing some discussions recently about more SPAC activity. We saw that several years back. I was just wondering, the panel's views, if there's an expectation that might be another successful method for shipping issuances. Jay, you're shaking your head, I think.
Sure, I'm happy to start. I think I'm not a SPAC expert, but I can surmise in terms of I think the history of what we've seen with SPACs. I think there's been some level of success, but for the most part, I think it gets pretty challenging. And I think without getting into all the details, I think one of the challenges I think with a SPAC could be that if the valuations for shipping companies are not trading at levels that, certainly when we saw companies trading at premium to NAVs, that's a much easier discussion with SPAC holders, where there is obviously dilution with the SPAC securities that investors would have versus companies if they're trading below NAV. I think it's just much difficult to do a SPAC. But again, I think I would applaud those who can get SPACs done. I think we're aware of several shipping companies or principals who have done that recently. I think who have obviously the pedigree and the investor confidence that they can potentially find something to do in this space. But again, I think it's history. I think if you just look at the history of SPACs in the space, I think it's sort of mixed results.
Jay, you mentioned NAV. I like the panel's views generally on how are you evaluating the companies? How are you analyzing the companies that are out there with respect to their trading and their NAVs? Adam, did you have any views?
Well, I actually had something I was going to follow up on Jay's point, which is I think what's unique to the shipping space, and it comes into the SPAC area, is you have an ownership structure within shipping that allows for a degree of flexibility and creativity that's virtually unseen or unparalleled in any other industry around. So whether that's MLP, SPAC, other creative forms of financing, you're really, in most shipping companies, dealing with a couple of key decision makers, and you can get ideas and structures in front of them quickly. And from an investor standpoint, to the extent that you see an ability to structure alpha for your funds, this is an industry where you should be truly focused on that.
Great, thanks. Any views on valuing the companies today, or would you rather not discuss that particular topic? Yeah.
No, sorry. So repeat that.
I was asking earlier, we were talking about net asset values, and some companies trading below NAV and the like. How can investors invest in a company trading below NAV? How can that?
Well, they have a large population to choose from right now. I think maybe to tie two things together here. One is the deals that have gotten done, the secondaries, and then the NAV question. Leaving aside technicals in a stock that may have the valuation disconnected, or a distressed company that's trading on some kind of option value, the NAV, these low NAVs reflect, unfortunately, we can only conclude the investor's view of forward NAV. Okay, so that's the very bearish view. If you're trading at 70% of NAV today, it's because the expectation is that values are going to fall and that forward NAV is what's reflected. That's what investors, in theory anyway, anticipate the future, and so they're making a bet today on what they expect for the future. Having said that, what has been working, which is, again, consistent with the defensive market, if we were to say, look at all the various deals that have gotten done, TK's raised some capital, and of course there's a story around that. C-SPAN has raised, every company that's raised capital has a story. GasLog has raised. Generally what we've seen is companies that offer yield to the investor. And so the investor, if we were to say, what is the investor, where deals have gotten done, and this isn't in all cases, but in many cases, the investor is focused on the yield and the predictability and how much he can or she can believe that yield is sustainable, and the NAV as a consequence, is sort of a byproduct of that valuation.
You mentioned yield, and I was going to get to this question later, but I guess it's appropriate now. When I was sitting in this very room about 6 months ago, I vaguely recall someone calling the death of the MLP. Is that still the view, or have those views changed? Andrew, I know you and I had discussed this the other day. If you wanted to start off on it.
Well, I'll start. I didn't have that view back then. I think, the MLB's traded off so much, and a lot of that was a big technical trade, which is to say, there a lot of redemption activity that was driving forced selling, and that, a lot of energy crossover investors into the MLP market that were exiting or being forced to redeem in a market where the investor was running away from energy. So there were a lot of reasons why the yields on fine companies blew out. And I think it's fair to say that, TK reducing its dividend, TK, not to seem to appoint blame or anything, but it's a bellwether company, very respected company with good management and so on in our sector. And so when they reduced their dividend, that was the earth moving under people's feet, investors' feet. So I think there were a lot of reasons why the MLP market traded off so significantly. It's come back, and our view at Credit Suisse is that in a low interest rate environment, which we thought was temporary, maybe it's going to be here a lot longer, in an aging with an aging population where there's large asset classes, investors that want income, that the MLP has a place there. It maybe is a more selective market for shipping, where investors are going to be more intensely focused on the contracts and charter coverage and so forth, and charter counterparties and so on, than it was maybe a few years ago. But I didn't predict that at the time. We don't believe that at Credit Suisse. But it may just be a more selective market for ship owners going forward.
Yeah, I would agree with that. I think with MLPs specifically, I think what we're seeing is, not all MLPs are created equal in the shipping space, and I think there's definitely more scrutiny among investors in terms of looking at the contract coverage. There are many good MLP companies out there in the shipping space, and we've seen, as Marius referenced, GasLog, for example, doing their follow-on offerings, and you're seeing the yields coming in again for many of these names. I think a lot of them, frankly, were just impacted overall with what we saw with the slide in the energy sector. But I think we've definitely seen companies rebound and the yields starting to come back in again for those, again, who have the strong cash flows and duration. But I think there are obviously some MLPs in the shipping space where people look at it and say there's only 1 year of contract coverage. That's very difficult to justify. So I think that makes it more problematic, and that's probably the companies that I think people may have seen that have not recovered yet. But I think certainly in terms of in a yield environment today where it looks like we could be in a pretty low rate yield environment for a while, I think these MLPs clearly are going to prove valuable, and especially those with long cash flows.
Well, you mentioned that no MLPs are created, or all MLPs are not created equal. Since the name of this today is New York Maritime Forum, I would suggest not all capital markets are created equal either. Sitting in New York, I do take a very strong personal view that we have the largest, most liquid markets out there for shipping. We have the most expertise, and it continues to grow by the day. We have some real healthy, solid companies in the tri-state area that are growing as well. I guess the question to start off with this line of questioning is, why is London never really just taken up? We were listening to a panel on Brexit this morning. Why have the UK capital markets really just not taken off?
Well, I think first of all, when shipping became sort of a publicly traded vehicle in itself, you had the Norwegian exchange, which had already for a long time a large number of public companies that were dominantly family-owned, had no liquidity, you had no say. And then the U.S. market opened, and that changed the whole game of publicly traded shipping companies. It was a floodgate of capital. It was enormous. You could tap almost anything you wanted when the market was open. I simply think there was no room. There was a first mover advantage into the US market, and I simply think London fell behind. And when you have such an efficient market, when it comes to, there's probably the largest cluster of shipping is probably in Norway in terms of insurance companies, technology, management companies, etc. Other than that, in pure capital, nothing matches the US capital market. There's a lot of talk about retail, investing in shipping. From my experience in shipping, this is an institutional asset class. We have some, like Stifel's done a great job with mini bonds, is that what we call them?
Baby bonds.
Baby bonds. That is sort of a retail instrument. But in general, I think this is an institutional asset class. The tickets in itself in shipping is big for being shipping, but in the overall US market, they are small. A couple of $100 million compared to, last night, Anadarko did a $2 billion overnight offering to buy oil assets. So, it's easy to, because of the embedded volatility in shipping, it appeals so much to typically hedge fund industry here. And I think the market here is so cemented, I don't think London really has anything to offer in addition.
Any other views from the panel on that question? I guess follow on a little bit more, I guess, as well. Are we going to see competition, say, from a burgeoning Asian capital markets?
I'll take a crack at that. I think what makes New York, the New York market, unique, and I think it is the case that the Scandinavian markets have been accessible and important to the shipping industry. So this isn't meant to be an either-or comparison or statement, is just the absolute dollars among America's institutional investors with the array of risk-taking and the degrees of freedom those investors have means that there's just more investable dollars here that can be, that the shipping industry can attract. And that's one of the reasons why, away from the shipping industry, tech companies that are Asia-based may go public here and so forth. In the UK, for example, to draw a comparison, to come back to your earlier question, a very high proportion of the absolute investable dollars and among UK institutional investors are tied to the FTSE 100 or limited to the FTSE 100. And so the absolute dollars available there are such that you don't have the infrastructure and dynamism and investors and lawyers and just infrastructure, research and so forth that is the whole ecosystem that surrounds that you need to have in order to have a vibrant capital market for shipping. So we have that here in the U.S. It is unique, and I think it's important in New York. Although we have to be mindful if you're advocating for the New York Stock Exchange or for the NASDAQ and the capital markets here that we can't. Other markets can do that if they wish. They can adapt and make themselves deep and attractive too. And so, but for the time being, the New York market is uniquely deep for shipping markets, and particularly, as Marius says, for institutional investors.
Yeah, it's very hard to imagine the U.S. market, and frankly, I would categorize also the Norwegian market as ever being displaced, I think, for shipping, simply because that's where the companies are listed. Very hard to list in, I think, the UK when you don't have many comps in the sector that you might be looking at. So I think just by the sheer fact of the number of listings and the comps that you would need, I think it's just hard to imagine the U.S. market in particular ever being displaced.
Well, I'm glad to hear, I think I'm hearing that the whole discussion of whether or not shipping was suited for the public markets with respect to disclosure and the old, say, Greek shipping families' views on privacy and not wanting to disclose, it's gone. It seems like we're way past that point now. But it does lead to the second question, and I'm not sure we are past the point of the cost of being public for shipping companies, scalability, and the size of shipping companies basically being a mid-market sort of a thing. I was wondering, Adam, if you might lend your views on, is it too expensive, both by way of dollars and by a way of administrative time for shipping companies to be public?
It really depends on the scale of the company that you're talking about. It's the same argument that you can make about is it best to be a single B rated company, a double B rated company, or investment grade rated company. It really depends on the size of the company and their capital needs. So obviously, the larger the scale, having access to the public markets is very important, and it drives down their total cost of capital and opens up much larger pools of money. We at Stifel, I think we've done a good job, and over my career, of pioneering putting new pools of capital into the shipping industry, and some of that's focused around retail, and some of that's family office work. But you can't get access to any of those, which tend to be very attractive forms of capital, unless you're a public company. So that's sort of our view on it here.
Thanks. So we've heard about all these great big wads of money floating around the New York market, and many of us have seen them. The question is, we have a lot of PE that is currently well invested, and they're getting towards what people viewed as perhaps the end of the desirable timeline for their involvement in certain investments. Are we going to perhaps see a window where they can implement an exit strategy of bringing some of these companies public, say within the next 12 months, do we think? Jay?
Yeah, sure. We obviously spend, I think all of us here on the panel spend time with sponsor-backed companies, and what I would say is that I don't get the sense that anyone is feeling the pressure necessarily to have to exit. I think they're looking at every option that's on the table, whether it's in the form of a outright sale versus some sort of combination. But I don't get the sense that anyone is feeling necessarily the pressure to have to do something in the next 3, 6, 9 months. Having said that, we do know that for many of them, they have made this investment now, which is close to the end of its cycle. And so I think there could be some more internal pressure going forward if nothing gets done in the next 12 to 24 months. And so I think a lot of this is going to depend on, I think it's company specific, sponsor specific, but it would be, I think our view would be that we are aware of discussions, and I think depending on the right opportunity, we might start to see some combinations or transactions take place. But again, I don't view that as being imminent, just because I don't get the sense that anyone's feeling forced to do anything right now.
Yeah, I agree with you on that. I think the majority of the private equity investments that took place in the last few years, I think most of them are just going to sit very still for quite a while. I don't think you'll see any movement there. Over the last 12 months, I think the company that was most active trying to offload this position was Ridgebury, which in a falling market did not take place. And I think that will be for most of the companies.
Well, I apologize for having kept the conversation generic with respect to shipping, because all of us in this room appreciate that it's a multifaceted industry, and there are various different peculiarities with respect to sectors. And this, I was wondering perhaps if I can just go down the line and ask you what you see coming back perhaps first, an LNG or a tanker. What do you view as the most positive story in the markets these days?
Well, if we're going down the line, I guess that's I'm going first, and my colleagues can rebut me. I think there, if we were to say where might there be a light at the end of the tunnel and what could we see, I think LNG clearly would be, you mentioned LNG, but I think LNG, not just because the markets tend to be more open for that today, but just the supply and demand dynamic appears to be such that the rate environment ought to be getting better in 2017. And so if you're an investor and it's 2016, then maybe you're anticipating that, and so those markets will be deeper. And I think that is more of a technical trade. It's also just long-term, the dynamics for where gas is and where it's needed are attractive. So I think investors are drawn to that more naturally. Having said that, I think and I think if we went down the, we've been picking on, dry bulk has been, picked on for a long time and been out of favor for a long time. But I think, the level of, without predicting that that's the next bull market to emerge in the next 12 months or something, I think the level of scrapping is important. It's high. This is what the industry needs. I think that we're seeing a bit of a commodity rally. That's important too. In the end, there are so many ships on the seas that we need a demand. The tide needs to go up. We need a demand-driven, some fundamentals to help drive the rate environment up over time to catch up to all the capacity on the seas. And we're beginning to see a bit of that. And so I know some of the analysts have published, calls that, hey, this is the bottom or some such thing. Who time will tell. But, I think certainly gas, has good fundamentals. And again, we're just seeing some things that suggest that, we might have a better rate environment over the next, if not the next 12 months, over the next 2 years with some bumps in the road for dry bulk.
Anyone else have a view on the next best market?
No, I think I'll take the absolute opposite and say that if I could predict the future, I would not be sitting here. Clearly, dry bulk is like a Supermax, 10 years old, gone from $2,000 a day to $7,000, $8,000 a day. Seen tremendous signs of improvement there. The LNG, Fearnley Securities as a corporation, we're very, very positive to the underlying dynamics in the LNG business. Nevertheless, I think it is wrong to compare LNG and dry bulk if you're going to make a shipping investment because they are so completely different in its nature. One is a long-term industrial bet and the other is a cyclical bet. So beyond that, I'm not going to try to predict the future. I'm just a humble banker. I assess value to things and then we sell it from there.
If there are no other views on that, we are running short on time. I did have one major question I wanted to ask. Consolidation with the state of the current markets. Are there great opportunities for consolidation, or do we go back to the old argument that consolidation just does not work in shipping? Adam, do you want to perhaps take a crack at that one?
I think that given ownership structures within the shipping space, the notion that there's going to be a huge wave of consolidation is probably misplaced. To the extent that there are consolidations, or I think it would come more in the form of restructuring, and I'm thinking specifically in the drill ship space would be where I would spend time if that's what I wanted to look at. So, feel that.
Any other views on consolidation in shipping?
I think it's fair to say that, sorry, I don't mean to talk a lot on this panel, but in an industry where the only entry to the barrier is cash and everything else can be outsourced, and the cash hurdle is relatively small in the grand scheme of things, I don't think we'll ever see any particular meaningful consolidation. I think the best example of consolidation is probably shipping pools that contract much larger fleets than individual shipping companies.
We're running a little short on time. I would like to just get back to the original question that I posed and asked you to contemplate during the discussions, which then are the capital markets, in particular New York, I would suggest, a valuable tool in the toolbox of shipping?
I think, I guess I would go first again. I think if we step back from the current sort of malaise in terms of the valuation environment and so on, and I think it was said earlier that we still are sort of in an early phase, maybe 20 years into the public shipping industry being really tested in the public markets in a meaningful way. I think if we take a step back from that and just presume that bank capital, which was touched on in the earlier panel, is going to be a smaller component of the overall shipping balance sheet going forward, and yet this is a capital-intensive, important, growing industry globally, some other amount of capitalization, some other amount of capital is needed by the shipping industry in order to finance assets. And so that can come either from private ship owners coming out of pocket more and having bigger personal balance sheets to do that, which is plausible, but I think unlikely in most cases. And if you just assume that there's a component of bank and there's a component of equity, then there's a piece in the middle, and that's what the capital markets can provide. And so if we were to predict, this is a prediction I will make, if we're sitting here 20 years from now having this same panel, capital markets will be more important for shipping companies and more prevalent in more shipping companies than they are today, simply because ultimately, these assets need to get financed, and the private markets and the bank market certainly isn't going to be there for them. So is it an important tool? Yes. But for investors need to see better returns on capital over time in order for them to participate more broadly, in different tranches of the shipping balance sheet.
Well, I think we have time for one question. If anybody has a question in the audience, we're a bit over our time.
There's a big wall of debt, bank debt coming due over the next 18 to 24 months, and structurally it's going to be more difficult for the European banks to roll it than it has been in the past. It's been suggested that that money's going to have to come out of the capital markets. I'd be interested in what the panel has to say about that.
Jay, you represent the big bank.
Sure, I can start. Actually, it shouldn't be a surprise that we are seeing more and more, I don't want to call it necessarily a restructuring, but a recapitalization where there are solutions which involve support from the bank side as well as new junior support. So, for example, if you look at BW Offshore, they did a rights offering, which also entailed, so obviously the insiders coming in with new capital, help support the business, and in exchange there was a bank solution in place that provided relief. And I think those are the examples I think we're going to see more and more of, where if to the extent that a company is still able to raise external junior capital, I think that's the carrot that's used right now to try to work with banks to come up with a solution, certainly for the medium term, especially with near-term bank that may be coming due. And so, and we're seeing that also on the bond side as well, where we've seen transactions where Norwegian bond holders have agreed to extend maturities in exchange for obviously more junior capital coming in, and so we've seen that also take place. So, at some point, I think you, either as a bank or as a bondholder, you have to assess whether the company is sustainable even with the junior capital coming in place, and whether that provides the necessary cushion. But so far, we've certainly seen cases where there is willingness to work with the company, and especially as more junior capital comes in.
Thank you. And I think we're out of time, and at the risk of getting in a little bit too much trouble with Olga, I believe that one of our former keynote speakers actually had a question. Michael, please, the last question for a wrap-up.
It won't take time because it's a comment rather than a question. I think just to the London, as it was connected to Brexit, there are no shipping companies left in the UK. If you go back 100 years, the equity markets in London would be the dominant market in shipping. And I think that if you have no companies, no indigenous companies, if you like, particularly once P&O was broken up, and it's a dollar industry, that's the strength of New York. But let's not forget some of the scandals when people first came to the markets in New York, tankers in the equity market, some of the bond issues. So I think a lot of the development of the US capital markets has been based on experience of how not to do it, and has improved, and I think that's been a very important point. But the one thing you're missing, which New York does not have, is the largest sector of shipping is the container sector, which is consolidating massively and probably will be the example of the creation of your global utilities. Those companies will list somewhere, whether it's New York, whether it's Hong Kong, but I think that sector, which is really not as an individual sector, has very few pure container shipping companies in the equity markets, may well give the lead to how future equity markets develop. And I think, as we've talked before, the whole issue of digitization, the fintech, who knows where this may go. So whilst New York is clearly an excellent place to raise equity, don't be complacent.
Thank you. We'll wrap it up on that.